Taking a look at the currency market now with Shireen Darmalingam. She is macroeconomic strategist over at Standard Bank. Thanks so much, Shireen, for joining us this morning. Well, the rand we saw recouping some of its overnight losses against a struggling dollar, but on the back foot still against a lot of the other currencies. Seems like at this point we're starting to see the effects of the wage strike locally now hitting, fuel supply starting to weigh a little more on the local unit than it has in the past.
Indeed, yesterday we saw that risk aversion starting to dissipate on the back of the fact that we saw better than expected US housing data. We also saw good, encouraging US earnings data, and the fact that suggestions coming out from President Obama with regards to how they're going to handle that debt burden, as well as some optimism about the fact that the Eurozone may find some solutions to their debt concerns. So generally we saw the improved risk appetite starting to ensure that the rand enjoyed some short covering. But as you mentioned, that had been curtailed slightly by the fact that there has been those ongoing strikes in the fuel industry, and that did put some pressure on the currency.
Just how much shine has industrial action taken off the rand? Where would we have been in your books, without any of this action having persisted?
I think the rand would have been slightly stronger. We are seeing some kind of move towards 7 rand if we breach the current levels to the top side. But what's important is to note that the current strike, the fuel strike, which is currently in its 9th day, could possibly crimp economic growth going forward, especially in the second half of this year. We're seeing the manufacturing sector and the mining sectors already being impacted by that. And should the strikes continue and be prolonged into next week, we could see further damage with regards to productivity and crimping that economic growth.
Well, you're talking about a crimping of economic growth at this stage of the game, Shireen. Just how much, or to what extent is Standard Bank factoring in a slowing down of GDP?
Well, currently we have priced in a growth of about 3.8%, but should the strikes be prolonged, we could see the manufacturing and the mining sectors contribute less to GDP in the second half of the year compared to what we saw in the first and second quarter of this year. If you recall last year, or rather the past 4 or so quarters, the mining and manufacturing sectors has been the main contributors to GDP growth. We could see that come off if the strikes are prolonged.
Of course, this in a context where we've got rising inflation coming to bear as well. And with that, we're looking forward to those CPI numbers being released today. Remind us again of Standard Bank's expectations in that regard and your outlook for the second half.
We expect CPI to come in at about 4.9% year-on-year for June. Consensus is currently pricing in a 5% increase. We do expect the food and transport components to continue driving that, and expect inflation to continue heading north towards the end of this year. However, we don't believe that we would see a breach in the target of the upper limit of the target this year. We are penciling in a breach of that target in the first quarter of next year.
In terms of retail sales figures, of course, these are all economic data points that the SARB will be taking into consideration as it, progresses on with its MPC meeting, and that rates decision being anticipated tomorrow as well. Your forecast in terms of retail sales?
Our forecast is at 5.8%. If you recall, that is coming from a high of about 9.8% the previous month. We do expect trade to have normalized on the back of the fact that the April numbers were impacted by the holiday season, where consumers were spending quite robustly. And if these numbers do come in at the expected rate, it really warrants the Reserve Bank to keep rates on hold tomorrow.